Bell kind of flagged some of those risks, and we see the currency side particularly under pressure when it comes to EM as we see the surge back to King dollar. Does that kind of create a bit more risk when it comes to that emerging market strategy?
Well, I don't think so. I mean, on the margins, yes, but let's face it, emerging markets are in a very different place. And especially when we look at Asia EM, what we're seeing is the potential for significantly higher growth. What we're seeing is an environment in which monetary policy is relatively accommodative. So this is the kind of environment in which, given COVID reopenings, we could see great things coming from this space. So certainly there are always some headwinds, but I think the general picture is far more tailwinds than there are headwinds.
And that's actually your view when it comes to the US as well, where you believe that a recession is not sort of the writing on the wall at this point.
That's correct. I don't think it's a fait accompli. When we look at the U.S. economy, what we see is an incredibly tight labor market. And that, to me, is one key reason why the U.S. may be able to avoid a recession. There's clearly going to be a slowdown in the U.S., but since there are so many job openings, more than there are people looking for jobs, we could see an environment in which companies cut their job openings as opposed to having any kind of large-scale layoffs. The second argument I'd make for why the U.S. could avoid a recession is because the Fed is being so incredibly data dependent. It is pivoting quickly based on incoming data. That, of course, caused a more aggressive rate hike in June, but it could also work the other way. And so I think that the Fed is trying to make what is a blunt instrument like monetary policy as surgical as possible.
Kristina, David here. So to that point, and you might turn out to be correct that we don't get a recession, but certainly a slowdown is definitely in the cards, as you point out. Earnings estimates, global equities on aggregate, and this could be different obviously under the hood depending where you look, have actually yet to reflect any start of any revision, a trend in revisions down. Do you think stocks are cheap enough, is the question, going into the second half?
Well, stocks are very cheap, but it really depends on how much we see in terms of the downward earnings revisions. My suspicion is that we're not going to see dramatic downward earnings revisions. And so this is an environment in which I don't think we've hit a market bottom yet for U.S. stocks. But I think we could see a bottom in the next couple of months. And then we could see a nice rebound based on some positive surprise. Now, that surprise could come from the Fed in terms of pivoting to a less aggressive path for tightening for the back quarter of the year.
Talk us through then your calls across emerging markets.
So for emerging markets, what we see is a number of countries, ASEAN countries specifically, that have higher growth projections for this year versus last year. We're going to see an acceleration. And of course, we're going to see a reacceleration in China as well. That's really going to be an important catalyst for Asia EM. The role of COVID restrictions as monetary and fiscal stimulus should be very supportive. And I think that's why we've already seen the Chinese stock market start to forecast, start to signal a comeback.